A very good morning to you all, friends. I'm Sanjeev Singhal, Chairman of the Auditing and Assurance Standard Board and Vice Chairman of the Committee for Member in Industry. I welcome you all to the 116th program of AASB for this council year. Friends, from the AASB, it's been our endeavor to spread the awareness, to spread the knowledge about this specialized topic in the auditing and assurance standard. So me and my Vice Chairman Vishal Bhai Doshi have designed a bouquet of these standards which are to be taken up, a bouquet of these specialized topics which are to be taken up. And we are presenting the same to you one by one. Besides, we are also running a helpline, an expert helpline, where you can ask your queries pertaining to the auditing standards, those issues which you may come across during the course of your audit. It is free and it is available up to 30th of September. Kindly make best use of it. Friends, at the same time, we have also come up with the checklist on the auditing standard and the working paper templates as well. These are available for free to download. We encourage you to make use of the same. Now, coming to today's topic, friends. Today, we'll be discussing the key considerations in the audit of the renewable energy sector. So renewable, as you know, is becoming very important. It is the green energy. It includes the solar, the wind power, and the light. And it helps the planet to breathe easily. It reduces the carbon emission, rather generates the carbon credits, which can be used as an offset for those companies or those industries or those areas where there's a shortfall or where there's a net carbon emission. And there is a lot of focus of our government under the able leadership of our Prime Minister, Shri Narendra Modi ji, to generate more and more renewable energy, to increase the usage of the renewable energy. In the times to come, India will become a leader in the usage of the renewable energy. To deal with this topic, the specific audit issues, we have with us our two eminent speakers, CA Raisuddin Sefi and CA Palak Shah, who have been with us on previous occasions also. I'm thankful to both of them for continuously sparing their valuable time for the cause of the profession. So thank you, Raisuddin. Thank you, Palak.
Thank you, sir.
We also have two very young moderators with us. CA, of course, I'm not saying that Raisuddin and Palak are not young. They are also young. Maybe two younger moderator with us, CA Sakshi Sharma and CA Saloni Palod, who will be moderating this session. And I thank both of them for taking out time on Friday morning. So this is indeed a great pleasure welcoming four very esteemed professionals to the ICI webinar. And may I now invite Saloni to take up this session forward.
Thank you, sir. Good morning, everyone. First of all, I would like to express my gratitude to Chairman Sir, CA Dr. Sanjeev Kumar Singhal Sir, and Vice Chairman Sir, C. Vishal Doshi Sir, C. Anil Sir, and the entire Auditing and Assurance Standard Board of ICAI for giving me the opportunity to moderate this session today. I extend a warm welcome to all the participants for joining us for this webinar on key audit considerations of renewable energy sector. Today's topic is very important and relevant as the renewable energy sector is at the forefront of India's efforts to combat the current climate-related changes and transition towards a more sustainable future. With the increasing urgency to address environmental issues, renewable energy sources such as wind, hydro, and solar are becoming integral to our energy infrastructure. With this rapid growth comes the need for robust and thorough auditing practices. It therefore requires key audit considerations. And to help us understand those, we have two very learned speakers with us, C. Raisuddin Sefi Sir and C. A. Palak Shah Sir. It is my pleasure to introduce our esteemed speaker, C. Raisuddin Sefi Sir. C. Raisuddin Sefi Sir is an executive partner of the Assurance Division of ASA and Associates LLP. The organization has 8 offices with 1,000+ team members. He is a qualified chartered accountant and holds Bachelor's in Commerce degree from Delhi University. He is also a member of the Income Tax Appellate Tribunal. With more than 13 years of experience in auditing and financial advisory services, he specializes in carrying audits under Indian GAAP, US GAAP, IFRS, including risk-based audits, and IFCFR reviews. He has adeptly handled in AS and IFRS conversion and advisory tasks for a diverse clientele, ranging from large public sector undertakings to multinational corporations, banks, and foreign subsidiaries. Notably, he has also played a key role as lead financial advisor for esteemed corporate entities. His extensive experience spans across various sectors, including aviation, oil and gas, fertilizers, FMCG, power, automobile, textile, logistics, banking, IT, and education. Furthermore, he actively contributes to professional discourse as a speaker on accounting and auditing matters at esteemed forums, including ICAI, and assisted in the various publications of the Institute of Chartered Accountants of India. He has been the chairman of the subcommittee of technical development of the firm for consecutive 2 years. I would now like to request my co-moderator, C. Sakshi Sharma, to introduce C. Palak Shah, sir. Over to you, Sakshi.
Good morning, everyone. First of all, I would like to extend my heartfelt gratitude to AASP Chairman CA Dr. Sanjeev Kumar Singhal sir, Vice Chairman CA Vishal Doshi sir, CA Anil ji, and ICI for giving me this opportunity to serve as a moderator for today's session. I am truly honored. As my co-moderator CA Saloni Palod mentioned, today's topic is key consideration in audit of renewable energy sector. Given the rapid growth and increasing importance of this sector, this webinar is both timely and essential for gaining valuable insights. I would like to give a brief introduction about CA Palak Shah sir. Thank you, sir, for joining us today. CA Palak Shah sir cleared the Chartered Accountancy course in May 2009. He also obtained a diploma in IFRS from ACCA in December 2009. Additionally, he holds a Bachelor of Commerce degree from Gujarat University, completed in April 2007. He has been working as an associate director at BSR and Associates LLP, a chartered accountancy firm based in Ahmedabad since 2011. He has extensive experience in conducting statutory audits across various sectors, including industrial manufacturing, consumer markets, renewable energy, EPC, and infrastructure. Now, I would like to invite CA Palak Shah sir to begin his deliberation on today's topic. Over to you, Palak Shah sir.
Thank you. Thank you, Sakshi. I would like to take this opportunity to thank Sanjeev Singhal sir and Vishal Doshi sir and the entire ASB fraternity for providing me this opportunity to come again on this webinar sessions and speak about the sector and share my knowledge about the sector. I'll request Raisuddin ji, please, if you can share the screen. Yeah. So as Sanjeev sir has mentioned, the renewable sector itself is quite important sector for India's growth journey as an overall sustainability from the sustainability perspective. As we see, there are a lot of climate related issues. We are seeing impact of El Nino, and all this, it requires a sustainable effort by everyone. So renewable sector, which in itself is quite important in terms of the sustainable living, sustainable growth of for the India's and overall the global world. So if you can just move the slide, sir. Yeah. Next. Yeah. So if I talk about the sector, what is the renewable energy? So, and what are the sources of renewable energy? So normally what we hear is that solar and the wind energy are the most common, which we understand from the whenever we talk about the renewable energy. However, there are other like hydrocarbon, hydropower, wave energy, tidal energy, biomass, geothermal as well. These are all the various sources through which the renewable energy is generated. So when we talk about the green energy and renewable energy, there is always green energy is itself a renewable energy. But when we talk about what is the difference that comes in our mind, so what is the renewable energy and what is the renewable energy and what is the green energy? So green energy is always a renewable energy, but renewable energy cannot always be a green energy, considering there are some emissions involved. There are some unsustainable, because when we talk about the green energy is always about it comes with the ESG framework as well. So yeah, if you can move the slide. Yeah, this okay, I covered this. Yeah. So if we talk about the status on the renewable sector in India, where are we currently, or where are we placed in terms of the global rank, and what are the drivers, and what are the future outlook in terms of the sector? As Sanjay also mentioned, the government has considered this as the highest priority. If you see, government has set the target that we want to achieve the green energy, renewable energy installed capacity of 500 gigawatt by 2030. We are currently, if we see by April, we are already have reached a 190 gigawatt of installed capacity. More largely, it's coming from currently solar, wind, and the hydro. In terms of our ranks, we currently India is the fourth largest in terms of the installed capacity. China is continuing to be number one in this implementation and installation. What are the growth drivers? There are like this renewable energy is also linked with the ESG agenda of various industries currently. So while government has also set the various initiative like National Solar Mission, Hydrogen Mission, Wind Energy Mission, there are significant investments coming in this sector because of the ESG agenda of the companies across the world. If you see, most of the companies now are talking about the ESG, and renewable energy is the forefront of it, and through which only we can achieve these targets. If there are various in terms of growth drivers, if we see, there are various policies like the government has provided subsidies. There are PLI schemes, there are tax incentives, and there are renewable purchase obligations which are being provided by the government of India. So if you see what is the outlook, because considering the various climate impact, the renewable energy needs to be a reality. It will help to reduce the emissions. It will help to carbon neutral, and it will also help to create the jobs. So there is a expectation that it will create a more than 1 million of the jobs by 2030 through renewable energy. So if we talk about the sector, so what are the challenges and what are the operations or accounting perspective the sector faces? So before Saisud, if you can move the slide one more. Yeah. So what is the structure currently, if you see, in terms of the renewable sectors? So there are like government approval bidding either through a state government or through a central government through SECI or like Solar Energy Corporation of India. There are like PPA, there is a bidding the process. There are various companies, there are large players now coming in this industry. There are significant penetration being done. There are the purchase price agreement being entered into with the customers. Then considering this sector itself is highly capital intensive, it requires a significant investment because the return on investment it's quite long. If you see the recovery or the return on investment, these contracts are normally, if you see, are 20 to 25 years. So it requires a highly capital investment or a contribution in terms of, so there are a significant dependency on the financing, either through equity or in through bank. So considering the return on investment, there are high involvement of banks borrowings, if you see. Then once this financing and everything is done, then sourcing of material. So selection of the material, selection of the vendors. There are various very short players available currently in terms of the availability of like a solar panels and all. So there are high dependency on the in addition, there is a significant transformation being carried out currently in terms of the technology through which this manufacturing is getting done of the solar panels or other renewable energies materials. So there is a transformation. Once these materials and everything is procured, then it comes to the capitalization of projects. So and then it's a generation of the power once the project is completed. So if we talk about the overall structure, how it works, this is the summary of it. Now, if we talk about what are the challenges in each of this. So one of the challenge which we find as an accountant, or before we as a start in the auditor, what are the risks? Rather, as an auditor, if I have to tell you, So identification of these contracts as of these assets, whether that should be classified as a property plant equipment, whether it should be considered a lease or it will be a service concession. Considering there are the fixed rate which is entered into with the SECI or with the state government discoms, whether the agreement are for throughout the useful life of the asset which I am acquiring. There are so these are all the factors which determine whether we would classify this as a property plant equipment, service concession, or a lease. Second, the challenge here that is we observe is the land acquisitions. Considering this highly capital intensive, high investment, high amount of investment is required, and considering the government's requirement, the incorporation of the entities happens within across various entities within the structure of the group. So that it requires a lot of land acquisition. So land may be acquired in one entity while the project is being handled in the other entity, or by the holding company has acquired the land while the subsidiary is executing the project in because the contract with the SECI or the discom is done with the by the subsidiary company. So that required the challenge in terms of the title of the land. Second, as I mentioned, the procurement of raw material and the technological transformation being happening across the world on the solar panels. If you see the cost of the 1 megawatt of solar panels or solar energy, which used to be around 10 crore per megawatt few years back, which has now come to 4 crore or 3.5 crore in some cases. And there are a lot of other transformation or innovations being made in this sector in terms of the other means through which these panels can be manufactured. There is also an innovation being going on in across various industries, whether this can be manufactured through like soda ash. These are all the factors which impacts the challenge on the industry. Then the second, considering these contracts are highly capital intensive and there is a fixed rate contracts. So there are changes in the government policies which happens. So that caters challenges in terms of the going concern of the some of the entities, whether this will have an impact on the whether they will be able to generate the cash flows or not. While the rates are fixed, there are highly debts are fixed, but they have to service the debt also. This if they are not able to generate the adequate cash flows in the overall period of the contract, it may concern a challenge a going concern of the entity. Then there is challenge the companies come across with respect to accounting for the viability gap funding. As we mentioned, there are like governments which have provided the subsidies or the support uh, either in the form of like actual cash inflow or through other means like a land acquisition or all. So this requires a risk or as well as a challenge for the companies to how to account this viability gap fundings. Then considering this, some of the discoms, as we know, are not doing well. It concerns on the recovery of the amount which is to be obtained by the companies. So this requires a challenge in terms of an audit with respect to expected credit loss. Well, there is a school of thought that considering the government entities, the credit loss should not be there. But yes, time value money of impact is required to be considered. An associated point, if the companies are not able to obtain the funds or are not able to realize the money from the authorities for the supply of power, it may create the issue for them in terms of the servicing the debt because they are highly leveraged, right? And there are high competition currently because of the various large players now coming in the sector. So there are because of that, if the companies are not able to service the debt, it again can create a issue in terms of the going concern of the entities. So yeah, with this, I think I have covered largely the what are the risks or what are the challenges the companies face. With this, I will request Raisuddin ji to take the next slides.
Thank you, Palakji.
Thank you.
So thank you for rightly setting the tone of the session. So you mostly covered basically the key issues, or I would say the sector-specific risk which auditor needs to be aware of. So without taking much time, I'll start with the detailed. Just a second. Okay. So, friends, good morning. Now, as you know, you got the understanding about the structure of this sector. You know the basic insights about, I mean, what kind of the key issues when we go for the audit of these kind of, sector like sometimes you might be working on the NBFC, sometimes you might be working on the RE sector, sometimes you might be working on the oil and gas sector. So every sector is having their own risk. So as Palakji rightly mentioned, so there are specific risks related to RE sector. Now we'll understand, I mean, what are the considerations at different stages of audit, like what are the considerations or the focus areas at planning level, and what are the focus areas at execution level, and the other considerations at completion or the reporting level. So we'll understand what are the risks, what are the focus area, and how we will mitigate those risks while considering the audit procedures. So, so if you see this slide, so it looks like this is more or less common for all the sector. But believe me, based on my experience, if we are not having, the more focus on each and every aspect which I'm actually showing to you. So these are not the only aspect which we need to cover at the planning stage. So these are the broad level aspect which we need to consider while planning the audit for the RE sector. RE means the renewable energy sector. So independence requirement is must if we are planning an audit and our team or the engagement partner, or I would say the firm is not independent. So there is, I mean, there would be a big risk if we are accepting that audit. And the second point is the understanding about the entity and the industry. As Palakji mentioned, and in the opening remarks, Sanjeev ji mentioned, the understanding of the client where you are in, I mean, where you are planning to do the audit, and that particular industry is very, very important. And for example, if you are planning for a particular group, so you need to understand, I mean, how that group is operating, right? So in India, in general, this RE sector works in a SPV model, like holding and subsidiary model. So there is a group and they have the multiple subsidiaries. And the reason of subsidiaries is basically when they go for the bidding. So the requirement of bidding is to have the separate entity to cater that particular PPA, right? So in a particular group, you will find, I mean, multiple subsidiaries. So you need to first understand what is the model. Do they have only single entity or they have the multiple entities, right? And the second situation can be like what are I mean the structure. I mean how they are getting the funds. Are they are getting the internally generated funds, or are they are sourcing funds from the bankers? Whether the bankers are Indian banks or the foreign banks, or they are getting the fund from the bondholders. So and what are the requirement of bondholders, that you need to understand at the planning stage itself. And the second and third criteria of understanding would be, I mean, how they are generating the revenue. What is the source of, energy generation? Are they more focused in solar, or they more focused in wind, or the other, source of energy? So you need to understand the process of or the source of, generation of energy. And at the same time, if, for example, let's suppose since the solar is the dominating source of energy in India, so if they are in solar, you need to understand what kind of model in the solar itself they are following. Like, are they in ground mount business or they are in rooftop business, right? So both these models having their own risk and or dimensions. Like in the ground mount, you need the land, right, to set up that plant. and you need to enter maybe into a multiple leasehold agreement with the farmers, or maybe you need to sometimes acquire the freehold land to set up the plant, right? At the same time, for the rooftop business, you don't require the land. You need to have a contract with the private entities or the private for the private spaces like the warehouse, rooftop, etc., so that you can install your solar panel or the module at the rooftop. So you need to understand, I mean, what are the structure of that particular entity, how they are in, and at the same time, when you understood like how they are working, what's the, I mean, how they are sourcing the funds, and how they are, structured like the holding and subsidiary, then you need to understand how they are maintaining their books of accounts, right? Whether the controls are at the group level or at the entity level. Usually, based on my experience, the controls are at the group level, because the entities are just for the sake of admin purpose to manage the generation of electricity to comply with the PPA, right? Everything is managed at the holding company level, either the appointment of the internal auditor or the other auditors, and the maintenance of the books of accounts. You will find that this SAP is same, and these user are same. All the leadership team is sitting at the holding company level only. All the key decisions are taken by the holding company only. So you need to understand whether the operations or the admin activities of that particular group is happening at the group level or at the subsidiary level, SPV level. So either that decentralized or the centralized. So based on that only, believe me, this will give you the uh, more inputs while doing the internal financial control reporting, right? So testing of IFCFR may also be connected with the structure, how they are maintaining their books of accounts, and how they are controlling the entity. After getting the understanding, then you need to understand whether, I mean, based on the input from the client and based on the data available in the public domain, you need to understand uh, uh, like whether you are going to accept this client or reject that client. If you are going to accept that client, you need to understand whether that client is in the low risk category or the high risk category or the mid moderate risk category. The moment you conclude like this client is having the high risk category, then you need to enhance your substantive audit procedures also. You need to give more focus on your control process also, whether controls based on the previous audit reports, like the who was the previous auditor. So based on that auditor's report, are there any issues which needs to be considered while conducting the audit for this year, I mean, where you are appointed. So after the this client acceptance, then you need to move for the engagement formalities. So why I am focusing on these aspects, because many a times we observe that there are issues identified by the regulator also, like the peer reviewer also. Like we lack at the planning level, right? We directly jump into the execution. So we need to understand, I mean, how you are uh, doing the client acceptance for at group level or at the SPV level, because there would be a multiple entities. How you are drafting the engagement letter, what's the language of the engagement letter, whether that's meet the requirement of standards on auditing or not. And at the same time, you need to ensure that you obtain the NOC from the previous auditor if you are the subsequent auditor for that entity. So, and make sure that all the issues or the point given in the NOC addressed before acceptance. And after this engagement formalities, make sure that you have the prior approval from the audit committee for other services like the certification. Because many a times in India, especially, it's the requirement of sometimes the from the regulator or the customer side. Like if you are, for example, you are claiming for additional amount on account of change in law, like the reimbursement, right? So for that purpose, the customer require a statutory auditor to confirm that figure, right? So for that purpose, though that's the requirement in the capacity of statutory auditor, but still you need to get the prior approval from the audit committee for that services. Otherwise, that may be a non-compliance. Again, the engagement team, friends, this is one of the, the most important thing, because identification of engagement team who is having the relevant experience is very vital. If that a team is not having the experience of that particular industry, especially this RE sector, so you may not be able to conclude in a way which is expected as per the standards on auditing, right? So the engagement team means the starting from the engagement partner till the core team of your audit, and including the EQR which you are going to involve in that particular assignment. Then we need to focus on the risk assessment. As Palakji mentioned in the previous slides, like there might be a risk of competition, there might be a risk of regulatory, there might be a risk of technology. So there are multiple risks, right? So from that aspect, you need to sync that risk with the financial line item and see whether those risks which is specific to this RE sector are covered or not. For example, in a broad sense, if we say that, like in a simple word, if we want to generate the electricity from renewable energy, as Plugji mentioned in the previous slide, like the structure of RE. So if you think like we need to generate the electricity, what is the need? Need is that we need funds, we need plant. So if we need to generate the electricity, we need plant. For the plant, basically the PPE. So PPE may be one of the significant area. And second would be to set up the plant, we need the funds that we call the borrowings. So borrowing can be the another significant area, right? So, and the revenue, which is the presumed fraud risk, that could be the another significant area. And when you work in the multiple holding subsidiary structure, intercompany loans or the intercompany transactions or the RPT transaction could be the another significant risk area. So, for at this planning stage, the identification of risk and the fraud risk and the response to the risk would be the critical aspect, right? And another aspect is the minutes. So minutes of meeting with the engagement partner, EQCR, engagement team, and the communication with the TCWGs are very, very important. Now the issue would be like how you are communicating for multiple entities, right? Because you might be working for 30 to 40 entities, right? How you are communicating with those charged with governance or the audit committee, right? How you are discussing the planning either at the consolidated level or the entity level. How you are, getting the review points from EQR. So these kind of points should be there at the planning stage, and everything should be written in a minutes form. And the minutes should be very, self-explanatory. These minutes should not be ambiguous, right? Otherwise, these may create the problem. At the planning stage itself, the materiality in the RE sector is one of the interesting area, because see, if you are doing audit of a simple trading entity, so you may do the materiality based on the revenue or the PBT, right? But in the RE sector, because you might be working on the holding and subsidiary structure, right? In India, this is the common structure. So for that purpose, like for the operational entities who is generating the electricity, right? Not in construction. For that matter, you may say like the appropriate basis for materiality would be EBITDA or the profit before tax. But at the same time, you can't use the same materiality for the entities who is under construction, right? For that matter, you may go for the total assets or the asset base as the materiality. And at the same time, there might be a third type of entity in the same group, like they won the PPA, right? But nothing has happened, only some kind of legal expenditure or the incorporation expenditure is there. But for that purpose, you can't, just put everything on EBITDA or everything on PBT. You need to see entity wise what is the best base for the materiality. After conducting the benchmarking, then you need to conclude whether what would be the materiality basis for the operational entities, under construction entity, or the new or the shell entities, right? Similarly, for the sampling methodology, as I mentioned, you need to understand. So understanding of business is important. So based on your understanding, if you conclude that everything is managed at group level, so you need to understand, I mean, how you are going to plan your whether you are going to consider the group population as a single entity to compute the number of samples and to circulate and to do the testing of IFCFR, or you are going to do at entity level. So that you need to see for the control testing perspective and the substantive audit procedure perspective. And being the sector having the complex issues in at various stages, I would recommend to involve the auditor expert, right? For example, the capitalization of PPE, right? That may require the experts' involvement. For the checking of revenue may require the person who is expert in that particular industry. At the same time, to carry out the IT testing, like they might be having the single system for all the group entities. So testing of ITGC controls and the audit trail testing, which is the new thing in financial year 23-24. So for that purpose, I believe that our core accounting team may not be sufficient. For that matter, I think our IT team, auditor IT team, so do this net testing and align with the engagement team to conclude whether everything which is expected as per the standard is covered or not. So this is regarding the planning friends. Now we'll understand at the execution level, I mean, what kind of the issues we need to cover and how we are going to resolve through audit procedures, what kind of audit procedures we need to carry out. So I touched it a little bit, but let's quickly, I'll give you the recap. So internal control over financial reporting. So in India, as you know, this is not applicable on all the entities, all the private entities, right? So in case the entity is having the exemption, so you may not be able to, carry out the reporting. But at the same time, control testing, otherwise we have to do, right, for your filing purpose. But in case you are reporting for that purpose, I think you need to understand the business in detail. As I mentioned, like what is the structure, whether holding or subsidiary structure, whether that entity is having the government customer or the private players or the private customers, right? Because sometimes what kind of structure is generally in India, they have one structure is like the government uh, go for bidding. They ask private players to give their quote, and then that government maybe like the nodal agency like the SECI or the other discoms, so they acquire the electricity from that particular entity and then transmit to the discoms, or sometimes the discoms directly acquire from that particular entity. Another structure would be that entity set up their plant and sell to the private entities or the private players, or I would say sell at the IEX exchange. Another is the energy source, and like we discussed, what are the source like solar or wind, like the whether structure is ground mount or the rooftop, like the structure is I mean the at the group common environment or the decentralized. Sector specific risk, as Palakji also mentioned in his slide, like the project management risk is one of the major risks. Why this is a major risk? Because if you are outsourcing the setting up of that plant or the construction of that plant to subcontractor, right? If he is not able to complete or construct that plant on time, so there might be a penalty on your client because of delay in commissioning that plant, because these are the time bound activities. If you're not able to complete either by you yourself or through your subcontractor, you might be exposed to liquid damages. So another is the raw material risk, because uh, this industry not very old, it's very I would say moderately new, but yes, our dependency on the raw material like the solar cells, solar modules, and inverters and the transformers is still on the other countries like China and Vietnam. So for that purpose, there might be a risk of availability of raw material if the company is himself constructing that entity plant. And if you are everything is smooth, nothing is issue regarding the availability of raw material price. But another issue could be in the raw material itself, right? If you did the bidding, for example, in the last year, you quoted some rate, for example, 3 rupees per unit or 4 rupees per unit, right? And that quote was based on some cost you have considered at that level. But later on, if there is a steep increase in the price of raw material, that gonna be very big risk for the company, because there might be a reduction of margin due to increase in the raw material price. So that's the another risk. Technology risk is again the important area, because this industry is booming, and everyone is working on the innovation part, right? Everyone wants to spend low and wants to gain much, I mean most from this. So there might be a situation like the plant which you set up 5 years or the 10 years ago may become the redundant considering the technology, or may not be giving the expected the electricity generation. Another is the competition risk. Big houses are coming in, and private equity is also coming in this sector, and 100% FDI is allowed. So everyone wants to come in this sector and earn money as much as possible. So this competition is directly giving the hit on the tariff rate. So if you are, reducing your top line, so ultimately, focus would be on the midline, like you need to manage your cost. So if you are not able to manage your cost, this will directly impact your liquidity. Another is the regulatory risk. So lots of changes are happening, and ESG, as Palakji mentioned, is part of the ESG agenda also. So regulator are changing, like the government having the lots of policies. Sometimes they have, I mean, national hydro mission. Sometimes they have zero emission targets, and they have given some target in the COP also. So these kind of risk are there in this sector. Slightly change in the policies of the government may directly impact your business. And again, the liquidity risk, because this is highly leveraged sector, and primarily the sector work in 70 to 30 ratio or 80 to 20 ratio. Like 20% is sourced from the promoters or the shareholder funding, and the remaining from the bankers or the other lenders. So in case change in the raw material price or the project management risk or the competition risk, this directly impact your liquidity. And the moment your liquidity crunch arise, there might be a risk of going concern in that particular entity. So these are the sector specific risks which we'll cover from financial line item perspective in the subsequent slides. So below are a few key processes which we need to understand before conclusion on the ICFR, because the getting the control testing is the first step before you go for the detailed execution. So first you need to do the control testing. You need to get the comfort how the company is having the control, and whether they have the controls against what could go wrong scenarios. So the property, plant and equipment, including CVP, is the first key process, which I feel that this is the important to understand. And the borrowings, procure to pay, like, I mean, what's the cycle of your customer to pay? I mean, there might be a situation like the customers are paying in advance, or maybe in the lesser time. Like if you're giving the 30 days period, if they are paying in 2 days, so you might be giving the discount to them, right? Your auditor might be, your client might be giving the discount to customer. So being an auditor, we need to check what is the policy, what are the arrangement with the client and your customer. So payroll is another aspect. Why I'm saying it's critical to understand, because though it's, I mean, this is not this RE sector is not require so much of man powers, right? This is the technology based sector, but still there are two type of employees. One is the operational staff who is sitting at the plant level, very few staff at the plant, and a majority of plants sit at team sits at the holding company level, like the leadership team and the admin team who is managing the show. So we need to understand what kind of estimates management has taken regarding the recognition of their liabilities, and whether the attrition rate is high or not, how they are managing their payroll. Another is the financial accounting closing process, how they are maintaining their books of accounts. Do they have any issues with the previous auditor, and whether their controls are working regarding the FACP, whether management review controls are working effectively. That you need to see. Again, the investment is another aspect, because it's assuming it's a holding and subsidiary structure. So investment, or I would say the treasury, is one of the key aspect when, what kind of control they have while investing in that particular entities, and what kind of structure they have when they have the approval from the audit committee regarding giving the investment to the subsidiaries in lines with the Companies Act. Again, then cash and bank, ITGC. These are the another two areas where we need to gain the detailed understanding on these processes. Then we need to do the walkthrough of processes. So, friend, before doing the walkthrough of processes, we need to understand whether the information provided to you is correct or not. So, which we call IPE testing. So, information provided by entity testing is must. We need to see what's the source of information, whether the information provided to you is reconciled with the information appearing in this app or the other accounting software. And at the same time, you need to understand whether this information, uh, which is expected from the subsidiary software, like not if not from the SAP, like the HRMS or the FAMS, other software, whether that information is integrated with your main software, right? And you need to have the access of that software, so that you can, real time basis, you can see what kind of information is there, and the information provided to by the client is same or not. So the quality of basically the information provided to you needs to be tested. And this testing needs to be done at entity level, not at only at the group level. So of course the controls you can check at the group level, but the testing needs to be done at the group at the entity level, because the everything like the ICFR reporting and the financial statements and the auditors report, these gonna issue at the entity level. So for that purpose, every entity is the separate entity. Not you can't do everything at the group level. So you need to prepare the audit file, right, for each and every entity, and all the procedures at the planning and the execution and the completion stage should be at the entity level. Then we need to do the sample selection and do the testing of design and the operating effectiveness, considering the shared service approach or the group common environment approach or the decentralized approach, right? Like we do in the other entities. And based on your conclusion, suppose you concluded that your controls are fine, your testing of based on your testing of design and the operating effectiveness, everything is clean, everything is okay, then there is no problem, right? But what if you concluded that the controls are not working? In that scenario, this would be very alarming for you. Everything gonna change, right? If you conclude that controls are failed, in that scenario, you need to increase your number of samples, or I would say almost 80 to 90% of coverage would be there in high risk category of client when the controls are failed. So every aspect, like the cash and bank, you might need to cover 100%, like the revenue need to cover at least 80 to 90%. So sampling aspects sometimes diluted in case the controls are failed. So everything then dependent on the substantive audit procedures. Now we'll understand the substantive part. So friends, now onwards, in the subsequent slide, we'll understand the substantive audit procedures only. So the revenue recognition. So we understood the controls testing. Now we understand at substantive level how are we going to do the revenue recognition testing, or I would say the audit of revenue. So first, we need to review the accounting policy in lines with the applicable framework. Why I'm saying applicable framework? The applicable framework can be the US GAAP, can be the IFRS or Ind AS, or can be the other GAAP, right? So you need to see whether the accounting policies are prepared in lines with the framework which in which you are issuing your audit report. By assuming that we are in Ind AS, right, or the company voluntarily implemented the Ind AS, so we'll understand from the Ind AS perspective. So examine the power purchase agreement. I would say the PPA for the RE entities is like a Bible, right? If they are, I mean, auditor is not reading the PPA. In fact, each and every terms of the PPA should be on tips of auditor, because more or less you will find the PPA same, but not getting the complete grip of terms or the conditions or the stages of performance obligations will give problem to the auditor. So we need to understand, what is the life of that PPA? I mean, how much is the tariff rate, and what are the conditions? I mean, what are the, COD date, and when they needs to, deliver the electricity, and what's the, PLF rate? What's the CUF rate? Rate is basically capital utilization factor. They give the range, like, for example, minimum 12% of that particular computation you need to generate the electricity. Maximum you can generate, for example, there's a range called 12 to 20. So minimum you need to provide 12%. There won't be any penalty. If you are generating electricity more than 20%, then still there could be a penalty on the company, right? So you need to ensure what is the range given in the PPA. Then verify the connectivity report. So you read the accounting policy, you read the PPA, then you need to ensure that whether that plant is actually generating the electricity or not. So you need to verify the connectivity report with the COD date. There might be a situation, there might be a pressure from the regulator or the customer side, like you need to comply with the PPA. So PPA, for example, said like you need to complete within 3 years, and those 3 years needs going to over by say last 30th April 2024. So to save himself from the non-compliance, the company may consider the capitalization as 30th April 2024, right, in the books. But what would be the issue? Issue would be whether that actually happened, because only the connected report can establish that yes, that commissioning is done at that particular date, right? So this connectivity regarding the generation of electricity, of course the COD also driven with the approval from the customer, but again I would recommend to reconcile with the connectivity report. And then since this is primarily the source of the energy is, in case of solar, is the sun, right? So this is completely dependent on the weather conditions. So if, for example, these days in Delhi, the temperature is 45, 47, 48, right? So this is the best. I mean, this is good for these solar energy generation companies, right? They are at peak. Maybe in the monsoon season, they may not be able to match the highest. They may be able to, struggle to get the minimum, right? So we need to see the trend. We need to align with the IMD report, the weather reports. I mean, what was the conditions at that particular level, and at the same time, we need to understand. We need to understand what is the location of that plant, because if the generation of electricity in Assam may not be the same the plant who is generating the electricity in Rajasthan, right? So we need to see the location of that particular plant also. Then examine the meter reading report. So meter reading report is basically joint meter reading report. So one person from the customer side, one person from the client side, where your client side will sign the meter reading report, and based on that they will do the I would say the billing. So in ground mount and rooftop, the structure of meter reading is slightly different. For the ground mount, joint meter reading is okay, like one person from customer side, one from the client side, they'll sign the joint meter reading report, JMR, which we usually call, and start doing the billing. But at the rooftop, uh, I mean, the entity for which you are, giving the electricity, for which you are using their space of, I mean, roof. So they usually, get that electricity from you. So they ask you to provide the net metering. They ask you to prove that what kind of saving, how much, I mean, units you saved because of that solar plant at the roof. So net metering system usually followed at the rooftop, right? And capacity utilization factor, this is a very important in this sector. So for that purpose, you need to do the trend analysis, like, I mean, what was the, electricity units generated last year, or I would say last month or the last quarter, or sometimes we do the analysis day wise in comparison to the previous year. Then we need to do the seasonal analysis, and we need to do the industry benchmarking also for the CUF. For example, your client is showing in between, say, CUF is 10 to 15% or 10 to 20%, and that in particular quarter, your client is showing 15%, right? So you can check or analyze the revenue of the other company in the same industry. I mean, how much they are showing. But keep one thing in mind, like if you're doing the industry benchmarking, you need to check the geographical location of that particular plant also. As I mentioned, the plant having the location in Assam and the Rajasthan may not, generate the same electricity. Then you need to correlate with the revenue. See, in the revenue recognition, though it's very simple. So if you are having the SPV dedicated for a particular PPA, so what you gonna do? I mean, your company might give you the 12 invoices, right? Like on a monthly basis, they might be issuing the invoices, 12 or 24. I mean, on fortnightly or the monthly basis. I'm assuming like monthly basis they are issuing the invoice. So you will get the 12 invoices. It's simple. Like what you will do, you will just get the invoice and check the turnover from the or the revenue from the books. So because the risk is not with the tariff rates. Tariff rate is already fixed, right? So at least you are free, that you don't need to go for checking the pricing. Issue is with the units, right? Everything, every game, everything. I mean, regarding manipulation or some. I mean, what we call like the business statement could be done with the units only, right? So you need to give your more focus on the source of units considered for billing. Then interesting thing is the self consumption, because these plants are very big in size, right, in hectares, right, at different locations. So that plant in itself require electricity for self consumption, right? So for that matter, what is usually happen, so there are two type of structure there in India. So one structure is customer, like discom, for which you are dedicatedly supplying electricity. So they say like, boss, I don't want you to consume electricity, right? Whatever you are generating, you just sell to me. I will do the counter billing on you, right? Say they generated 1,000 units, and 50 units consumed by that plant itself. So 1,000 units billing, they ask us to, your client to do 1,000 units billing on your customer, the client's customer, and then 50 rupees billing client do on your client, customer do on your client, right? So now the in this scenario, the question comes, what would be the presentation of that, right? Whether this would be the purchase of electricity for that plant, or whether that should be the net from 1,000 minus 50, right? So the presentation is very critical for these kind of aspects. Another is the liquidated damages. As I mentioned, these are the time bound projects. If not completed on time, so there might be a penalty for not completion. At the same time, there might be a penalty for non supply of power. Maybe you may not be able to meet the minimum criteria, right? You might be having the liquidity damages claim from the customer side, or you may be supplying the high power. I mean, it's not, it cannot be in a way like you are having the high temperature in Delhi, right? You are having the high units. You supply everything to, your customer. So in that scenario, because see, why they are charging for the high units is basically everything. You are not the only, you might not be the only customer, right? Only vendor for that customer. So everything, whatever is generated, is going to a particular grid, right? And that grid is having their own capacity, right? So if that grid is having the 200 gigawatt capacity, and the other vendors of that grid are supplying, right? If that grid capacity and this is 200 and the supply is 210, so there might be a issue in that particular grid, right? So that's why they restrict the excess supply also. But situation where your client is supplying not able to supply the minimum electricity, so we need to apply our six senses. So it's not only we need to see the revenue only, we need to see whether that plant required the impairment. Because if that plant is not able to meet the minimum requirement, it means there are issues. There might be issues like that plant is damaged, or that plant is redundant, or there might be a situation that plant is require major repair, right? Or that plant is damaged due to natural calamities, like might be flood or might be fire. So that you need to sync. So these trends you need to sync with the other captions also. Then we need to reconcile the tariff rates as per PPAs. Sometimes what happened, usually tariff rates remain same, but in some of the cases I observed that customer ask the companies to revise the PPA to consider the impact of change in law. For example, there is an impact of GST, right? And that company is eligible to claim that from as a reimbursement. So for that matter, because sometimes customer says like, please revise the tariff rates, right? I'll make the payment based on the revised tariff. So you need to check the revised tariff rates also. It's not compulsory fix. You need to check on case to case basis. But in general, yes, these are fixed for 25 years. Generally in India, PPA signed for 25 years. Then examine any impact on the company due to change in law. So we need to check whether is it reimbursable as tariff is fixed over the period of contract, right? Uh, and what would be the treatment of this change in law reimbursement as per India's 115? So just to give you the insights about this change in law. So actually, as Palakji also mentioned, this is very capital intensive industry, right? I mean, heavy funds are required to set up. So, for example, they set up a plant having the value of 1,000 crores based on and for 25 years PPA they assigned. So based on that, they estimated like the tariff rate per unit would be 3 rupees, right? Later on, GST came into picture. GST says that whatever modules you are acquiring, right, either from India itself or from the other countries like China, that may have the safeguarding duty or the GST, right? Earlier, there was no GST exposure. So 18% or the 12% or the 5%, what would, I mean, as per the case, I mean, what the cost you are in. So based on that additional cost, your project cost from 1,000 crores to I mean may become 1,000 crores to 1,200 crores, right? So that 200 crores additional because of change in law is usually claimable because as per PPA, it's allowed that on account of change in law they can claim from the customer. Now the question is, if they are able to claim, what would be the treatment? Whether this will be adjusted again PPE, or this will be treated as a revenue. So it's a debatable point, but in India, usually the one view is this can be treated as a revenue over the period of the contract, assuming that this is generated because of the contract with the customers as per India's 115, right? So next aspect in revenue is check whether there is a sale of surplus power to exchange is in lines with the PPA, because sometimes when you do the construction and you start generating the few units of electricity in during the testing, so in that particular period, because customer may ask you to provide electricity only when the complete plant is set up, but before the complete plant is set up, there might be some electricity is produced by that plant. So usually those electricities companies, sell to these exchanges, and which is usually allowed as per PPA. But post PPA COD date, you may not be able to sell, right? So then reconcile sales ledger with the general ledger, then do the cutoff testing for the completion and do the revenue reperformance. Right after doing all these analysis, then do the revenue reperformance, like multiply units into tariff rates, and then identify the expected revenue, and then reconcile with the revenue reported in the financial statements. And of course, disclosure needs to be evaluated as per the reporting framework, right? So this is the revenue recognition. Another is the renewable energy credits, as uh, we understood from the previous discussions also. So this is part of the ESG, right? And so the global perspective is to reduce the emissions. So for that matter, because this is ultimately benefiting the the climate and benefiting overall the structure of emission reductions. So to motivate this industry, so there are entities. I mean, there are few agencies or bodies like the UNSSR and the other entities who are giving the carbon credit certificates, right, which you can sell in the market. So you need to check, I mean, whether what's the accounting policy, what's the document available with the company regarding the carbon credits. I mean, do you have you verified the certificates? Generally, these certificates are displayed in the portal. So you need to check the quantity of those certificates on the website of that particular bodies, and you need to check the status of that application also. I mean, how much claim they have filed for the certificates, and you can see the number of credits in the portal. So for that matter, there is a guidance note on carbon credit also issued by the ICI. So you need to see, I mean, how the accounting of that carbon credits are done, and regarding the unsold carbon credits, how they value that, and whether the inventory of their carbon credits are uh, disclosed in the financial statements or not. So that's the another aspect in this sector. Next is the subsidy oblique grant received from the government. So this is nothing but just the same point which mentioned by Palakji. This is regarding the viability gap funding, right? Suppose you set up a plant in Madhya Pradesh, and that particular state says, like, if you are setting up a plant in Madhya Pradesh and that plant cost is 1,000 crores, we will give you 200 crores of VGF. Now the question is, when you will recognize that VGF, right? So we need to see the agreement regarding the VGF. There is a dedicated document regarding the VGF. It's not something like a single letter. Based on single letter, you are getting that money, because lots of documents you need to submit to the agency. Sometimes SECI do this kind of exercise, being a nodal agency, and you need to see, I mean, what are the milestone or the performance criteria when you can recognize, when you can claim for that disbursement from the SECI, or I would say the nodal agency, and when you can recognize. So usually what happened, sometimes the structure of VGF is like, you got say for example 200 crores of VGF, 50% you got upfront, say 100 crores on day one, and the remaining 100 crores in 5 equal installments. Now the question is whether I'll recognize all the 100 crores, 200 crores as a revenue, or this will be treated as a grant as per Ind AS 20, right? Or if this will be treated as a grant, whether this will be deferred over the period of 5 years or over the period of PPA. So these are the situations which you need to check, right, and evaluate the disclosures. So usually the VGF accounting is considered as a grant, but it's depend upon the situation, right? Because this is not directly coming through the revenue from contracts, right? This is the additional benefit given by the central, the state government. Trade receivable, trade receivable is one of the favorite area of mine regarding this sector, I would say, because usually trade receivables. I mean, if you go for audit of RE sector, no, you will find very minimal trade receivables, right? Because this industry works in early payment way. For example, if you are, billing to the customer and the credit period is 30 days, they may there might be a policy like if they pay in 2 days, or they may pay on the same day or the next day, you may give the discount, your client may give the discount for the early payment. So the industry work in the early payment structure. But in a scenario where there are outstanding, that's the alarming situation. You need to understand whether that's the normal cycle period, like the 30 days they are having, or more than 30 days receivables are there. Because if there are outstanding receivables, issue issue is not like the receivables are outstanding. Issue is the reason of outstanding receivables, because one of the reason could be like the PPA was revised, right? And you are doing the billing on the new tariff rates, but client, your customer, is making the payment, I mean, your client's customer is making the payment based on the old rates. So everything is settled based on the old rate by the customer, but the difference of old and the new rates is still outstanding in the financial statements or in the books of accounts. So it means that the concurrence regarding the revision of rates is pending. Maybe client is not agreeing to that. Second situation could be you are recognizing the revenue based on the unit generated by you, but there is non-compliance or non-meeting the requirement of PPA to maintain the COF, right? If you are issuing the say 1,000 units invoice on the customer, and the requirement to generate the electricity is 1,200, so you are not meeting the requirement, right? So for that purpose, there might be a situation like the customer is altogether levying the penalty on you, on your client. Like instead of you are asking money from me, I'll ask money from you because I am getting this electricity shortage because of you from the stock exchanges or from the other suppliers at the higher rate. Because I agreed with you, you need to provide 3 rupees per unit, but I am getting because of shortfall from your side from the other supplier at higher rate. So you need to compensate me with the market rate available for which I bought that electricity for the shortfall. So you need to understand, I mean, what is the reason? Then evaluate the aging source, how they are drafting the aging. Usually you will find the error in the aging, right? And reconcile with the with the ledgers also, and do the ECL analysis as per Ind AS 109 ECL working testing. So based on Ind AS 109, trade receivables required to be governed through simplified approach. But there might be a situation where where outstanding customers having the interest component. If they are having the financing component, so simplified approach may not work. You need to go for the general approach. For that matter, you need to see, I mean, whether the credit rating is there or not. A stage-wise analysis is also required. So that's very critical exercise. And again, the provision metrics, like the provision metrics in the ECL, needs to be calculated in detail. And last, regarding this confirmation aspect. So the external confirmation from customer needs to be obtained, right? And sometimes there are situations like customer do not confirm, like the being a government entities. So you need to do the alternate procedures as per standards on auditing. And since the structure is like multiple subsidiaries under the group, so they sometimes like one subsidiary is selling to another subsidiary the solar modules, the excess solar modules available with them. So you need to check. I mean, whether what's the the policy between these entities, whether that transaction is appearing at arm's length price, and why this amount was overdue from the related parties, whether the disclosures of related party transactions has been duly given in the financial statement as per standard. So this is more from the trade civil perspective, right? Now the property, plant and equipment, friends. This is, I would say, one of the key line item of RE sector entities, because everything is based on the PPE. This is the source of, basically, this is the mode of generation of electricity. So capitalization of cost, though you need to review and read the capitalization policy as per standard, but at the same time you need to understand the controls around that, whether there are controls effective regarding the capital expenditure, because there are huge capital expenditure happened being a turnkey projects. And date of capitalization of assets is another aspect which you need to see in detail, because as I mentioned in the previous slides, like these are the time bound activities, and COD dates may be tempered or may be correctly mentioned, may not be correctly mentioned in the FAR or the accounting software. So that you need to check with the underlying records in detail and align with the PPA compliance, and then examine the costs associated with the development, construction, and the installation of renewable energy projects as per India 16. So check repowering cost also. So as I mentioned, the repowering cost is nothing but just the situation where, for example, you need to supply 100 megawatt to a customer, and the life of that PPA is 25 years. And you set up your plant, you are generating the electricity, you place the solar modules and the complete infrastructure at ground mount. But over the period, the technology degraded over the period, right? So the solar cells or the solar modules who are generating the electricity on day one may not be generating the electricity at that level after 5 years or 6 years, right? But you need to supply the 100 megawatt, right? So for that purpose, over the period, that plant may not be able to meet or may not be able to generate 100 megawatt, right? Maybe 95 or the 90 megawatt. So to meet the requirement of PPA to generate the electricity at 100 megawatt level, you need to install the additional solar modules or additional solar panels to generate 100 megawatt, right? So this is called repowering cost. So you need to understand whether that additional 20 megawatt capitalization is repowering cost, or it's the repair of damage happened in the plant, or that's the replacement of that particular asset. So that you need to check in detail, right? And the depreciation amortization, it's basically it's require auditor to reperform, right? Because there might be error in calculation of depreciation and amortization. I would always recommend to reperform, and uh, after reperformance, then analyze the you know output of your reworking of depreciation with the client working. Then check the additions of solar modules, panels, cells, or if you are directly constructing the plant, the raw materials also, and the capital work in progress positions also. And I would highly recommend to carry out the physical verification also. So the physical verification is very interesting exercise in this sector. It's not something like you are in trading entities and you are just picking the uh, materials from floor to shop to floor on sample basis and just doing the physical verification. No, it's very, very, I would say, scientific, right? It's not simply you can just walk and count the solar panel, right? So sometime you require the technical team to help you in the physical verification. Sometimes they use the drone also, right? Because the space of, size of that plant is so big. I mean, sometimes you require days to verify that, to roam that particular plant. So, considering the geographical structure of that plant, you need to use the technology and how reliable the technology is. Google Earth feature generally used by uh, uh, the, the physical verification consultant also, right? So you need to understand how management is getting the comfort on the verification, right? What kind of altitude, etc., they have used, right? Whether the mapping of or the drawing of that plant is in lines with the image appearing on real time basis that's in satellite, right? So that you need to see. I mean, how you can get the comfort on the physical situation of that asset. Of course, the cleaning. I mean, you can do the n number of analysis. You can check, like, I mean, who is doing the cleaning of those modules, because if you are not cleaning those modules, that will reduce the capacity of electricity generation. So these days, I think robotics are being used by the entities. So the robots are cleaning automatically, but still the humans are involved who are doing the cleaning, right? So you can analyze from the cost of cleaning with the the panel they are cleaning and the report submitted by the company for your review. Assumptions, yes. So there are two type of cost: direct and indirect. So direct costs are like the raw material, etc. You are acquiring, you are just capitalizing, right? The issue is with the indirect cost. Like if you are constructing the plant, so there might be some employees also, right, who are involved in that particular plant. So there might be direct employees like who are dedicatedly on that particular plant, like the engineers or etc. There might be some admin staff also, right? So you need to evaluate, I mean, how management is allocating the cost of employees, right? And till what period they are considering as a cost of PPE as per the standard. Borrowing cost capitalization is one of the critical aspect, because this company, or I would say these entities are highly leveraged, right? And completely dependent, I would say, on borrowings. So the major cost of, I would say, major cost for the company would be the interest on borrowings. So they may require, the management may be focusing on allocating more of interest on the PPE rather putting in the expenses. So you need to check the basis. There might be a direct borrowings or the indirect borrowings. Direct for the particular plant only, so that may be easy to allocate. But there might be a situation like you may have general borrowings also. So I mean, what's the basis of the allocation of that interest on those general borrowings, right? On direct borrowings, whether that plant was suspended, what was the treatment of interest capitalization on those period, right? And whether that suspension was temporary or the permanent in nature. If that suspension was permanent in nature, then there more, I mean, then you may not be able to capitalize, right? Then you need to see from the other angle, like whether the impairment is required or not, right? So the assumptions used by the management in this regard, you need to see in detail, right? You need to check, I mean, the rationale behind that. Again, the CVIP. So, of course, after conducting the audit procedures, what we do in other PP, you need to verify the aging also. Like, I mean, what's the status of project ongoing, and whether that project is, I mean, overrun project, and and whether the disclosure as per the Companies Act is given regarding the overdue projects, and whether that project gonna become the onerous contract for the company, because initially they thought like they will be able to, complete in 1,000 crores. Now they already, I mean, at 50% and incurred, 800 crores. So that may become the onerous contract. So that kind of a situation you need to evaluate, because the moment they conclude like this is gonna be onerous contract, they may go for the cancellation of PPA, right? So in case of the moment they go for cancellation of PPA, that particular entity where that PPA is signed, that entity may be subject to going concern. Going concern issue. So impairment of property, plant, and equipment. So many of uh, us can be thinking like, it's a simple way. We have a plant. We are generating the electricity from sun, right? This is the mode of generation of electricity only. What could be the scenario of impairment, right? But there are situations like there might be a situation like your plant is outdated, right? There are new technologies in the market, so your plant is not able to compete with the market, right? Your plant is not able to generate that electricity considering the climate conditions. And there might be a natural calamities like the fire or the flood in that particular area. Then in that case, you need to evaluate. And there might be a policy changes also, like the Supreme Court order or the regulatory requirement of the government of India, requirement that particular location. Like there might be a situation. In fact, based on my experience, there was a situation where Supreme Court asked few entities to relocate due to this bird sanctuary and all. Right. In that situation, if they relocate, they might not be able to get the favorable conditions, favorable weather conditions for that particular PPA, right? And then in that case, they may not be able to serve the customer, and that may require the impairment assessment. And since you will be having the multiple entities, multiple PPAs, so you need to obtain the project-wise impairment analysis and understand how they are considering discount rate, what is the basis of discount rate, EIR method, and VAT. Whether they are following the CAPM model or not. Like, last what kind of rate they have considered in the previous year, whether they change the discount rate in the current year, whether that discount rate is aligned with the cost of borrowings or not, right? And period of projections. How many years of projections they have considered, whether they have considered 5 years or they are considering more than 5 years. That you need to see. And you need to see the element in the projections they have considered. For example, they might have considered the capital expenditure, right? But the capital expenditure which is not agreed in the board, or that is not that is regarding the additional, that from the restructuring point of view, right? So that expenditure cannot be considered in the projections because, for example, the company is saying, I am incurring 100 crores in next 5 years. I'll incur 100 crores in next 5 years, and then my capacity would be 100 megawatt to 150 megawatt, right? So in that scenario, they will increase the revenue for 150 based on 150 megawatt for next 5 years. So that capital expenditure you can't consider in the projections for impairment testing. Only to maintain that capacity you can consider the capital expenditure, right? And if they are involving their expert to gain the understanding from that expert, have the inquiry with them and involve your expert to do the impairment testing and do the reperformance of that particular impairment what the management provided to you. And the last but not the least, regarding impairment, examine the estimates used by the management does not have error. So many a times, what happens sometimes if they are providing the working in Excel, there might be sometimes the error in Excel, and sometimes the discount rate or the basis of the discount rate they have considered may not be correct, and the projections they have considered are prone to error. So that working you need to check in detail. The hygiene testing of that working needs to be checked and in detail in terms of uh, technical error and in terms of the compliance with the standard, right? And perform your sensitivity analysis for the key assumptions. Like if they are considering 10% of discount rate, you can consider 10.5% or 9.5%. What would be the situation? If that assumption is at the edge, then you can discuss with the do charge governance in audit committee. Like these are at very edge, and these assumptions are require some kind of adjustment in the financial statements or the books of accounts and account impairment, and then conclude your audit procedure whether the headroom is available or not. In case headroom is not available, there is an impairment loss you are expecting, then discuss with audit committee and conclude, ask management to consider the impairment. Lease is basically as uh, my dear friend Palakji mentioned, the land is one of the key aspect, right? So this industry, primarily the ground mount business, is highly dependent on the land. Sometimes they acquire the land in freehold format, or some many a times, I mean majority of time they acquire leasehold land, right? So freehold land, in the freehold land, you need to check whether the titles are free, titles are in the name of the company, the titles are not in dispute, right? But for the assets who are on leasehold, uh, so in that case, you need to check whether the recognition. First of all, you need to check the classification, right? Before classification, also you need to check the completeness of that list of leases, right? Because that for particular one plant, there might be more than 100 lease, right? I've seen the situation where a company is having one plant, but the lease are signed with 600 leasehold, landlords, right? So you need to check the completeness of that land. You need to check the cost of that land. I mean, what are the incidental costs to that land, like the stamp duty for the land agreement and all, and then do the checking of. I mean, what's the basis of their calculation of ROU, how much the discount they have considered, whether they are considering the periodic reassessment or not considering the large volume of the lease, right? And is there any modification or not? Sometimes they might have, we have seen the situation where they leasehold landholders itself are challenging the company, like they want their land back, right? So they want to sold to, or there might be some family dispute with them. So so this kind of situations you will observe. So you need to evaluate what's the, I mean, the severity of that litigation. So then you check the discount rate basis for the right of use and the basis of amortization and the disclosure as per India's 116. So primarily, India's 116 work requirements you need to check. Many sometimes there could be a situation like the PPA signed for 25 years, and the RO is computed for 35 years, right? So now the question can be, how is it possible if the PPA is for 25 years and the leasehold, the lease deed is for 25 years, then how it can be for 35 years? So there might be a clause in that particular agreement that lessee and the lessor can extend this lease for next 10 years, right? So as per India's 116, you can estimate the life at initial stage for 35 years based on your estimate. Of course, you need to check the life of your PPE also. You need to check, the the expected life of your other underlying renewable energy assets also. In that case also, you can extend the life and expected life as per India's 116. Borrowings, though primarily directly indirectly we have covered, but we'll touch upon this. Loan agreement we need to understand. So loan agreement, as I mentioned, it's very critical if you are in. So there would be two type of loans. One is the external, and another is the internal. For the external, you might having the funds from the bankers who are based out of India or the outside India, or maybe NBFCs based out of India, right? You need to read the agreement and check the proceeds from the bank statement. And in case of foreign loans, you need to review the foreign exchange risk associated with that foreign borrowings, whether the forward cover is taken by the company or not, because there might be a situation of volatility in the exchange rates, right? And since this is highly leveraged, slightly increase in the cost of borrowings on account of foreign exchange may directly impact your liquidity. So in that sense, we need to check whether the company has taken the hedging for that rates or not. Then we need to do the reperformance of interest. So management will provide to you their own working, their own basis of comparison of interest, and along with the interest confirmed by the banker or the NBFCs. But I would highly recommend that you compute, because you will have the interest. You will have the loan agreement, have all the covenants in front of you, compute your own interest based on the information available with you, and align with the interest appearing in the books of accounts, and check the amortization cost of borrowings as per Ind AS. Say if you are getting the 100 crores of loan, right, at the rate of 10%, but out of 100 crores, 95 crores is the pure loan, 5 crores was the cost of borrowings. So you need to adjust that 5 crores against the 100 crores. Say 95 crores would be the funds proceeds from that particular loan. So the effective rate of interest may not be 10%. That may become the 11%, right, or maybe 12%. So you need to check whether the amortization of that borrowing is done accurately or not, whether they revise the EIR or not, right? And then see the derivative documentation and check whether the hedging is effective or not. If they have taken the hedging, though it's optional, if they have taken the hedging, you need to check whether the hedging is effective or not. For the effectiveness, you need to check whether you know they have considered the currency is same, right, and the contract is valid, and the coverage of the hedging is almost equal to 100%. And then review the working of capitalization of borrowings. This is linkage with the PPE as we discussed in the previous slide, right? The basis of capitalization of interest, and then covenant testing. So, friends, covenant testing is very, very much important. For example, if you have taken the loan from say Singapore, and that loan is in the form of bond, right? So, as per the bond agreement, there is a requirement to submit the financial statement, say by 30th June, right? And the requirement to submit the financial statement is as per US GAAP. Though irrespective, you are in India, everything is physically available in India. Your plant is based out of India, but your bondholder's requirement is to submit financial in the US currency as per US GAAP. And the date is say 30th June. If you are not complying with that, that would be the non-compliance of the covenant. So there might be a situation like the company may go for the waiver of that covenant, or the extension of the 30th June timeline, or they they may need to reclassify the loan. So that loan may be non-current to current, right? So the moment you classify non-current loan to current, because that may become the repayment on demand, it depends upon the conditions given in the loan agreement. So everything gonna change, right? So the current ratios will completely change, right? And then obtain the direct confirmation from lenders, both INR and foreign borrowings. It's compulsory, right? And then align with the balance appearing in the financial statements. Litigations. Uh, though it's very smooth structure from litigation perspective, but there are still the situation where there could be litigation could be on account of dispute in title deeds, or on account of the tax demands from authorities, or maybe some notices from the regulators or the environmental agencies, right? Maybe uh, uh, a situation like you are having the plant and they are asking you to relocate because of this environmental impact, like due to radiations and all. So these kind of litigation situation might be there, that you need to evaluate. I mean, how management is concluding that particular uh, notice, or the particular litigation is contingent or not contingent, right? If that is contingent, why that is not a liability, right? And whether that is in case they are considering that as a liability, whether all the component of liability is considered, like if they are considering the principal as a liability and there is interest element of it, right, whether interest is also considered as a liability or no. So that we need to consider. So the most important thing is the completeness. So completeness of litigation tracker is important, and of course you need to involve your expert, right? So gone the days when everything we were relying on, the information provided by the client uh, uh, 20 years ago, 30 years ago, because nowadays it's highly technical, like highly complex issues. So we need to involve our expert to do the due diligence in detail, and do the PPR assessment, and then conclude, whether that particular litigation is probable or the possible, or whether this required either disclosure in contingent or that require in the liability section as per financial statements. And everything, the outcome of your conclusion needs to be discussed with the TCWG, like in the audit committee and all, right? Another aspect is the going concern assessment. Like if your company is, just give me a second. Okay, so if you are constructing the plant and your vendor is not giving the appropriate credit to you, or withdrawal the credit period early decided with you, so there might be a liquidity crunch, right? You may not be able to serve. Another is the negative operating cash flows. There might be a situation the company is running in the losses, right? These are the indicators. And there might be a situation like your based on your analysis, financial ratios are negative or not in favor of the company. And this is most important. Check whether the payment of borrowings are regular and whether the company is able to meet its payment obligation. So there are, as I mentioned, there are two type of borrowings. So the company, first you need to check whether the company is complying with the external borrowings. Second would be the internal borrowings, right? In the form of the compulsory convertible debentures or the optional convertible debentures, right? Or the ECBs. So if they are not complying, their internally sources funds also, right? The loans from the subsidiaries or the fellow subsidiaries or the holding companies. So that you need to report in the CARO as well, and this will directly impact your going concern assumption. And in case there is a situation like the net worth of that particular SPV or the entity is negative, or the cash flows are negative, right? And net worth is fully eroded, right? In that case, you need to obtain the financial support letter from the parent company. Now, the catch is you need to obtain from the suppose there is a structure like you have ultimate holding company, you have holding company, you are subsidiary, you are auditor of subsidiary, holding, and the parent also. So your subsidiaries having the going concern trigger, your and the holding company is having the going to getting the parent support letter from the holding company may not be feasible. You need to ask the support letter from the ultimate parent company, right? Because this your parent holding company is itself having the trigger of material uncertainty related to going concern, right? So it's always better to get the confirmation of the support letter regarding the financial and operational support from the ultimate parent, right? And there might be a situation like management intends to liquidate because if the project is onerous and they want to liquidate the company, they want to cancel the PPA. In that scenario also, there might be a situation like the company is subject to not for going concern. And loss of KMPs may be the situation. Shortage of labor and important supplies. As Palakji mentioned, our dependency is still on the other countries like the China and all. If they stop supplies, getting the you know uh, uh, raw material or the renewable energy assets on a timely manner could be the issue. And because of that, our commissioning may not be on time, and this could be non-compliance, and ultimately directly leads to the going concern and loss of major market and key customers. So here every entity is having only one or two customer maximum, right? So key customer would be one or two. If that if the company is not complying with the PPA and the customer is not wants to work with that company, then this is directly impacting the going concern, right? And again, this is the non-compliance with regulatory requirements, like as I mentioned, the environmental and the other government policies. And they analyze the impact of pending litigation. Like we have to check the pervasiveness of that, the litigation impact. If the impact is so huge that if that outcome is go in your uh, against your entity, your clients against, then uh, that may directly impact your company's operations from financials and the operational aspect. So that may impact the going concern. And again, so few uninsured catastrophes like the fire incident happened, but nothing was insured. So you're not able to, cope up again. So in that case, also the going concern issue may rise. As we discussed in the previous slide, I quickly tell you what's the gray area here. So we many times communicate with those charged with governance, or I would say the audit committee, but sometimes we fail to consider all the aspects, right? So it's always better to consider all the entities and communicate at all the stages, like planning, execution, and completion level. And your communication with the TCWG should be regular, right? And the minutes of all the communication with TCWG should be documented in the audit file, right? And this is the statutory requirement. I mean, because all these standards and auditing are the part of. So it's not something like it's optional; it's compulsory. Everything which is written in the SA 260 is mandatory to comply. Litigations we have covered. So this is primarily basically focusing on the process and how the companies are concluding, and what's the management assessment regarding the litigation. And you have to coordinate with the legal counsel directly if they involved the legal counsel directly, and involve your legal counsel also, or the expert also, and then conclude and do your detailed PPR assessment and discuss with your EQCR also. Use the work of internal auditor is another aspect. Like if internal audit is managed at the group level, right, for the entities, so you need to check. I mean, how many entities are covered, right? Whether the scope is sufficient to cover all the financial statement line item, whether the timing of report was appropriate, whether the the deficiencies identified the internal auditor is useful for the statutory auditor, if the deficiencies are related to the controls, right? What are the analysis or the considerations given by the statutory auditor? And sometimes when you conclude that you are not relying on the work of another auditor, then this aspect needs to be concluded in the audit file. Like you are not relying on the internal auditor work or the other auditor work. So this is regarding the accounting estimates. So few are the areas wherein the management use their estimates. So assumptions used in the litigation assessment is one of the area. Basically, the situation could be like the company received a notice, say GST of 100 crores, right? And they might be having the view like, we just received the notice and we are fully compliant, and this is just the notice, and we will not be able to, this is not going to go in our against, right? We are going to manage this. So we are not going to show this as a contingent liability also, right? So you need to discuss in detail, right? I mean, why this should not be the liability first, and if not liability, why this should not be the contingent, right? So you need to do detailed PPR assessment and understand what kind of assumptions management is taking, right? And similarly, there are lots of assumptions management, take while doing the assessment for PPE and the loan extended to subsidiaries, right, in the form of loans and the investment. Then you need to understand whether the impairment assessment is accurate or not, and the adjustment are the acceptable as per the standards requirement. And at the same time, you need to understand whether the treatment of that loan or the investment given to the subsidiaries are correct or not. Because if that loan is CCD, that may be subject to equity, right? OCD, that may be an element of compounding, and there might be a different nature of financial instruments. So you need to check one by one and assess whether that is in lines with the Ind AS. Again, the estimate of useful life of PP and ROU. So you need to check whether the useful life considered as in the PP and the right of use is similar or different. If that is different, then there should be a clear reason and the justification for that as per the standard. And at the same time, there might be a situation that, like, because considering the huge number of land, either leasehold or primarily the leasehold, so for that purpose, the asset retirement obligation liability is must to be recognized in the books of accounts as per standard, right? So what is the basis of asset retirement obligation? How they are getting the quote from the vendor to get the rate, right? Say after 25 years, you need to hand over that land, right? So the retirement obligation needs to be, accreted, and then the present value of that cost needs to be recognized day one in the financial statement, and then the deferred tax assets. So since uh, earlier there were some tax holidays also given for this sector, right? And the companies are having, you may find like the companies are having the accumulated losses also, and the unobserved depreciation also. So for that matter, the company may be considering the deferred tax asset. So the basis would be the projected taxable profits. So you need to understand, I mean, what's the basis of their estimates for the future taxable profit in spite of continuous losses since a few years. And if that reason is not, sustainable, you need to discuss with the audit committee and ask management to revise their working for deferred taxes. And assumptions used for actual evaluation. So though they might not be the huge payroll, maybe 400 or 500, depend upon the company size. I mean, that's not the, the point. Point is, if they are considering the employee benefits like the gratuity and the leave encashment based on the actuary valuation, so you need to check what is the data sent to actuary, right? What are the source of getting the information, whether the HR is directly sending to them or the finance team is involved into them, and check the data which is sent to the actuaries in line with the financial statements and the books of account, and then start asking the question on the assumptions used in the actuary valuation. You might have the question or the discussion with the actuary also. So assumptions may be the what is the basis of increment rate, attrition rate, mortality rate, interest rate. So all these factors you need to understand from the the client, or for so to say discuss with actuary also. And the assumptions used in fair value measurement of financial instruments like the deemed equity, how they are considering deemed equity, how they are considering compounding financial instrument, how they are doing the fair value of security deposits, how they are considering the amortized cost of borrowings, ACBs, whether the EIR is computed as per the requirement of Ind-AS. So these aspects you need to check and discuss in terms of estimates. So this is the last slide regarding the completion reporting, though it's common for all, but I'll touch upon from RE sector perspective. So communication with TCWG, as I mentioned, regarding the misstatements and the internal weakness is compulsory, mandatory. You need to communicate with them. And your evaluation and conclusion of identified risk and misstatement is very, very important. If friends, if you are, you have done your exercise in detail at planning level, execution level, but your conclusion is missing, right? Your diligence and conclusion is missing in the completion section, so there is no point of working on that particular caption. So your completion section should clearly depict that your how you concluded that particular caption. And after you after that, you need to do the audit procedures for the subsequent events when you complete your all audit procedure in principle, and then obtain the written representation, including representation on IFCFR. And engagement quality reviewer involvement should be there at all the stages, including planning, execution, and the completion level. And the review points of the QR should be closed before issuing of audit report, right? And issuance of audit report should be as per the standard, right? And check whether the requirement of respective captions are duly complied and considered in the audit report. Like if there's an indicator of material uncertainty to going concern, that para should be there. If you are the new auditor of that company, you are replacing previous auditor, then the other matter para should be there, that previous auditor was another auditor, and his report was not modified, and in case was modified, what was the reason for modification, right? So that you need to report in the audit report apart from the qualification matter which you are going to report based on your conclusion. And the last but not the least for today's session, the assembly and the archival of final audit file within 60 days after auditor's report. So 60 days is the maximum time limit, though the firms have their own time limits to compile and archive the file. And this is time for assembly, arrangement of, and the archival of file. This is no timelines for the audit procedures. Though all of you are aware, but just it's my uh, suggestion. Like we need to complete everything uh, on or before issuance of audit report, right? And few assembly and the archival process you can done in next 30 days. Don't wait till 60 days, right? That's all from my side. Now we are open for questions. I can have water also meanwhile.
Thank you so much, sir. Uh, Thank you so much, Maheshwari, Sethi sir, and Palaksha sir, for such an insightful and informative session. The knowledge and expertise you have shared based on your experience will undoubtedly benefit our audience. And now I would like to ask some questions. So my first question is, can the units generated in one state can be supplied in another state? And if the rules of the state governments are different, then which rule will prevail and how the same can be audited?
Palakji, I'll take this question. Huh?
Yeah, sure.
So, see, this is completely dependent upon the location of your discounts or the customer, right? If that customer is located in different location and if required to transmit that electricity at different location, so it's ultimately depend upon the grid he is using and how the arrangement is with them. I mean, it's not synced with the GST, if I am getting it right. It's not SGST or IGST, so that's the incidental part of it, right?
Okay.
So along with that, Sakshi also relates to the infrastructure because in transit, otherwise the generated electricity can be lost if there is no proper infrastructure, power transmission lines are available. So it's very important where the unit how will be transferred.
Correct.
Okay, sir. Thank you,
Yeah.
sir. My second question is, what will be the depreciation rate for ground-mounted solar plant? And how about charging of the depreciation and how about revaluation of these plants?
See, there is no rate as such, right? So the concept of rate has been changed now to useful life, right? And usually in India, the useful life for these kind of assets, especially for the solar sector, is 25 to 35 years, right? So why I'm saying 25 to 35 years, it depends upon the entity's usage and the condition of that particular asset. So some of the companies may be considering 25 years for the depreciation, and some of the companies are considering 35 years. But uh, if you see the Schedule 2 requirement, so the life might be different, right? So again, everything is synced with the useful life assessment of the company.
Okay, sir. And my last question is, what are the possible business risks associated with it? How it needs to be addressed and whether being addressed by the management, and how should the auditor be able to find these out to arrive at a conclusion?
So as Safi also touched upon, and we have covered in terms of the risk associated with this business is because the long gestation period is involved in this business, and there is a lot of dependency on the weather. So this PLF, the CUF, which we say, what is the weather conditions? So that is how my revenue generation capabilities will be dependent, and that's all will drive my servicing the debt as well. So this is the major risk which we see, and there are what are the regulatory changes which is happening, like ones happened in relating to GST and the project management what we as a company they are catering to. If there are delays, then as Safiji mentioned, there could be potential liquidity damages which can come on the company and that can impact the cash flows.
Correct.
Thank you, sir. Now I would like to hand over to my co-moderator, C.S. Saloni Palu, to ask any further questions or something.
Well, thank you so much to both the speakers for this insightful session. Such detailed presentation has definitely enhanced our understanding of the topic. We have a few questions from the participants. The first one relates to the accounting practice on repair and replacement cost of operational spares and parts. So in industry, the repairs are called as correctives, as we know, The minor repairs is called as small correctives, while the major ones are called as large correctives. The cost of large correctives, such as replacement of transformers, gearbox, blades, would be significant. The rotors and gearbox cost in crores. So your views is requested as some organizations adopt the practice of capitalizing all the repair costs other than consumables and amortize them over 5 to 10 years as against the gap of expensing the repair and replacement costs unless it adds to the useful life of the asset.
Yeah. So if you see this major cost which is incurred with respect to like transformation or replacing the solar modules, which actually enhances the capability or the generation capacity of the plant, which should be either ideally capitalized. In case of it, you want to add anything else?
Yeah. Actually, this is called repowering cost.
Yeah, repowering.
So
Yeah.
if there is a depletion, or I would say the downgradation, which is usually happen, right?
Happens,
So
yeah.
over the period of usage of that solar modules, I would say the actually not the solar modules cells
Sales, yeah.
got reduced in generation of the electricity. So for that matter, to maintain the requirement of that particular PPA, the repowering is also required. And just to add, if for example, if we have to we have a PPA of 100 megawatt, and for that matter, to generate 100 megawatt of electricity, so this electricity works in AC and DC format, right?
Mm.
So for 100 megawatt electricity, you may need to incur 125 of megawatt
Solar module.
capacity of solar modules, I would say,
Right.
because DC capacity is high more than the AC capacity. So your cost of capex is linked with DC capacity, not with AC. AC is synced with the PPA. So DC capacity is the important aspect in terms of capitalization. So from DC perspective, we need to see, I mean, how much degradation is there and how much repowering cost we need to carry out.
Okay. So the next question is, normally insurance claim receipts are accounted on cash basis. However, in case of machinery breakdown, for example, windmills, whether we can postpone the accounting of the cost of repairs under insurance cover on finalization claim, considering the large repair cost, which is much significant.
I think, first of all, allow me, if I'm correct, the cash basis of accounting of insurance claim is not there in picture now, as per Ind AS, right? It's highly, completely based on the management assessment, right? So if the company filed the claim before 31st March. And if based on the compliance of insurance policies and the claim they have filed, and based on their best assessment, if they assess that, yes, say, if they file the claim of 100 crores, right? And if they estimate, yes, out of 100 crores, 90 crores they will receive. And if auditor is also agree with their view, and based on auditor's assessment, it's okay, like 90 crores is fine, so they can book the receivable, right, based on assessment. It's not like on cash basis they can recognize it as per Ind AS. So, and yeah, Palakji, you were saying something?
Yeah. So in conservatively, the company can also look into the whether surveys happened and whether what the survey is approved.
Correct.
That also can be one of the factors which can be considered in recognizing the insurance claim.
Yes.
While not totally going in the on the cash basis, but whether the surveys happened or not from the insurance company. That can, and also you can consider the previous trends, whether some previous incidents are there or not with respect to insurance claim, and what was the precedence with that can help the management to estimate the realizability, and basis that trend they can also estimate what the amount they can recognize upfront.
Right. And in case of large claims, I would highly recommend, like, you can have a meeting with the insurance company,
Yes.
right, directly, just to get the real-time insights and the genuine insights.
Sure. So the next question is, what would be the accounting treatment when the date of capitalization is different from the date of implementation of the PPA agreement?
No, actually, this is not practically possible,
Yeah.
right? So PPA or signing date is the first date, starting point, and that require then 2 to 3 years to construct or the complete that project, right? So the date of PPA and date of capitalization would be different altogether. So first step would be date of signing of PPA. Then after 2 to 3 years, there would be a commissioning date for that particular plant.
Okay, sir. The next question is, if the discoms are not viable, then in such case, how to disclose the overdue from discoms, whether they would be treated as recoverable or they are subject to some provisions?
I think it's very clear. If so, discoms, I am assuming like they are asking from customer perspective. If customer is not able to make the payment, they are not viable. So in that case, if they are getting these insights from the customer side itself, so of course there is no point. You need to recognize the provision, right? Now the question would be whether you need to consider as per the simplified approach in the ECL, or you will directly recognize 100% provision for that. For usually for ECL purpose, we should stratify the population of receivables. So the normal receivable needs to be considered for ECL calculation, and the other, like the disputed one or the special case where the customer is insolvent or in the bankruptcy condition, or they are not able to make the payment. So usually 100% provision needs to be considered.
And sir, the final question. Can you please throw some light on the impairment practice of outdated technology materials, especially high cost materials like towers, hubs, engines, gearbox, rotors? That is whether impairment is required as soon as obsolescence is noticed, or that can be done in installments to avoid vitiation of the yearly profits or operational results.
In terms of renewable industry as such, once the plant is implemented and you are able to generate adequate cash flows through your power load factor, and there are no concerns with respect to servicing your debt, there is no requirement to impair. Otherwise, if during the implementation phase only there is concerns with respect to the technology, then and there is a change in the regulation by the government now that they don't want this nature of the instruments, but they want to change it. That can be the scenario. Otherwise, once the commissioning is done and the power is already started, has already started generating, it will not impact unless the government is asking you to reduce the rates, which is already agreed in before, which can impact your generation capacity of the cash flows. Otherwise, I don't believe the impairment is required.
Thank you so much, sir. That answers all the questions. Now I kindly request Anil sir for the vote of thanks.
Thank you so much, madam, for a wonderful coordination. Both of you, both the moderators have wonderfully coordinated as well as during the question and answer session. So, first of all, I would like to thank Palak sir for the wonderful deliberation and Isuddin Sefi sir for such a detailed and elaborative and very, very informative deliberation. So, from the core of my heart, as well as on behalf of AASB of ICI, I extend my heartiest thanks towards both the learned speakers, Palak sir and Isuddin Sefi sir, for his valuable time, expertise, and knowledge shared with all our members. So, thank you so much once again towards both the learned speakers, and I also thanks towards both the moderators for today's webinar. They have shared. They have well coordinated today's webinar as well as during the question answer session also. So thank you so much on behalf of AASP of ICI. I also extend my heartiest thanks towards the participants of today's webinar. So now we are closing this webinar. Thank you so much, everyone. Thank you.
Thank you so
Thank
much,
you.
sir.
Thank
Thank
you.
you. Thank you.
Thank